If you're here, you're either an ESG or sustainability professional, or someone trying to make sense of all the buzz around sustainability reporting. Maybe you've heard terms like carbon footprint, climate impact, or ESG scores, and wondered, what does it all mean? More importantly, why does it matter? Sustainability is no longer just a nice to have. It's a responsibility. Companies are now expected to measure, track, and report their impact on the planet and society. And that brings us to sustainability reporting. Most companies start sustainability reporting for one of three reasons. Regulatory compliance. Governments around the world are tightening ESG disclosure rules. If you operate in Europe, you have to comply with CSRD. If you're in the US, the SEC has its own reporting requirements. Globally, standards like ISSB and TCFD are shaping sustainability disclosures. Companies that don't comply risk penalties, reputational damage, and even losing access to investors and markets. Investor and market pressure. ESG performance is no longer a nice to have, it's a key factor in investment decisions. Investors want clear, transparent reporting on sustainability risks and opportunities. Companies that can demonstrate strong ESG performance are more likely to attract funding, partnerships, and long-term business growth. Brand reputation and consumer demand. Consumers care about sustainability more than ever. In fact, studies show that over 70% of consumers prefer brands with strong environmental and social commitments. Companies that communicate their sustainability efforts clearly build trust and strengthen their brand reputation. Regardless of why a company starts sustainability reporting, they quickly realize it's not as simple as ticking a few boxes. So, what exactly is sustainability reporting? At its core, sustainability reporting is how companies measure and share their impact on the environment, society, and governance. Think of it as an ESG report card. Just like financial reports track revenue and expenses, sustainability reports track carbon footprint, social initiatives, and governance practices. It typically covers three key areas. Environmental, E. It generally answers questions like, how much carbon does your company emit? Are you using energy efficiently? What's your approach to waste management and biodiversity? Social, S. It generally includes information such as how diverse is your workforce? Do your employees have access to training and fair wages? How do you engage with local communities? Governance, G. Governance have information of are you following ethical business practices? How transparent is your executive pay? What's your approach to data privacy and corporate governance? But sustainability reporting isn't just about numbers, it's about accountability, trust, and action. Sustainability reporting sounds simple, but in reality, it's a maze of challenges. In this video, we'll touch on the biggest ones, and in future videos, we'll dive even deeper. Problem 1. Lack of standardization. Imagine this, you're a global company. Your European operations follow CSRD, your US team complies with SEC rules, and your suppliers are reporting under GRI. But these frameworks don't always align, meaning one report doesn't fit all. That's where the chaos begins. But what exactly are ESG standards and frameworks? Standards provide specific, measurable criteria for ESG performance. They ensure consistency and comparability across reports. Examples include GRI, Global Reporting Initiative, SASB, Sustainability Accounting Standards Board, and IFRS ISSB, International Sustainability Standards Board. Frameworks provide the structure for reporting but allow flexibility in implementation. Examples include TCFD, Task Force on Climate-Related Financial Disclosures, CSRD, Corporate Sustainability Reporting Directive, and the SEC Climate Disclosure Rules. Frameworks like CSRD, SEC, and ISSB are like different languages for sustainability. Companies must translate their data to fit each one, which takes time, effort, and expertise. Problem 2, the data collection nightmare. Now, let's say you're responsible for collecting sustainability data for your company. Sounds simple? Let's break it down. You need monthly electricity consumption data from all your offices worldwide for Scope 2 emissions reporting. So, you email facility managers and wait. For social metrics, you need employee training data from HR, health and safety stats from operations, and supplier ethics reports from procurement. Each department tracks this differently, or worse, doesn't track it at all. The result? A painful, months-long process with missing data, endless follow-ups, and uncertainty about accuracy. How do leading companies manage these ESG challenges? Align with key frameworks. Identify the ESG standards most relevant to your industry and geography, and structure reporting around them. Centralize ESG data. Use dedicated ESG software or platforms to automate and streamline data collection from various departments. Engage stakeholders. Early get buy-in from finance, HR, procurement, and other teams early to ensure smoother data collection. Regularly update compliance strategies. Work closely with legal teams to stay ahead of changing regulations. Thankfully, we're in 2025 and AI is changing the game, not just in chatbots, but in sustainability reporting too. Imagine if ESG teams didn't have to spend months gathering data, chasing responses, and deciphering complex regulations. That's where Carboledger's AI-powered ESG agents come in. Because sustainability reporting isn't just about meeting requirements, it's about building a more transparent, accountable, and sustainable future. Carboledger, your AI-powered ESG partner. Try it today!